Good day to all. This is our first part of internal control processes discussion. Actually, much of the discussions here have been discussed already in your auditing theory subjects, so I expect that you guys are able to know already majority of the details, of course. As defined, internal control is a process designed to provide reasonable assurance regarding the achievement of the following objectives at the bottom. Now, this particular definition is provided by the causal framework or the committee of the sponsoring organizations of the Treadway Commission framework with regards to internal control. Internal control can be viewed also as a procedure, a step, a framework, a convention, or procedures, or the plural senses of such. Then the following objectives will be achieved by internal control. We would be able to have effectiveness and efficiency of operations, fairness and reliability of our financial reporting, and compliance with applicable laws and regulations. And just a side note, with respect to these objectives, these are also the types of audits that we should know of. We have the operational audit, the financial statements audit, and the compliance audit. And of course, the operations audit is actually one course or subject in the new curriculum. Moving on, here are some key points. People at every level of an organization affect internal control. So whether we like it or not, even those at the bottom, even those at the top, normally those at the top will set the entire climate of the organization, will affect such. Then it is to some degree everyone's responsibility. We cannot just say that because you're the boss, then you might just, let's say, set it aside so that your subordinates will be working for such. No, that will be your overall responsibility. At the same time, those at the bottom, the subordinates, will also have to accept responsibilities about the maintenance and the sustenance of internal control. Now, we can say that internal control is effective or if it helps an organization achieve its objectives, as discussed a while ago. Now, for some books, the objectives can even include the fourth one, safeguarding of the corporate economic resources or assets. Of course, internal control should be safekeeping and safeguarding those. Otherwise, the organizations would be affected when it comes to the short run and long run, more on the, of course, long run later on in terms of management of a company's resources towards attainment of the corporate objectives. It keeps an organization on course towards its objectives as said. So if this is like a ship, the sail would keep it towards its objectives. We can view the internal control as the sail. Then achievement of its mission and minimizes surprises along the way because we are doing what we are ought to do. So we will not be surprised in case that we will be audited or somebody will be going over with our work. Then internal control would promote, as said, about effectiveness and efficiency of operations. Then we would be able to minimize the costs or the least amount of resources will be consumed towards the fulfillment or achievement of the objectives and compliance, as said. In terms also of financial accounting, then the reporting would be reliable. So all transactions are recorded properly, then at the correct time, with respect, of course, to the management assertions that we have known in auditing theory, just like currents, completeness, and all. Then all recorded transactions are real, properly valued, so with respect to accuracy, then timely basis in terms of recording. So we have the cutoff, then properly classified and correctly summarized and posted for presentation and disclosure. So the management assertions are hit by the internal controls. We must take note that as much as we want that internal control would be able to achieve those objectives, but the assurance would only be reasonable, not absolute or perfect. It's because whether we like it or not, there are some rooms for errors, but of course, these are immaterial, insignificant, and non or not substantial. So effective internal control helps an organization achieve its objectives, but it does not ensure success, but it can help. towards the achievement of the word success. There are several reasons why we cannot actually have absolute assurance. First is cost benefit realities. We have to take note that under the cost benefit analysis approach, benefits must exceed the cost or costs, but it's not going to give us 100% assurance. Remember, the terms benefits and costs can also include not only the quantitative factors, but also the qualitative factors. Then collusion among employees. Collusion means that one employee works with another for the perpetration or for the commission of fraud or fraudulent transaction in the business. And the more if it involves different people from different departments or different levels in the organization, and the more if it involves a top management even. And external events beyond an organization's control. So uncontrollable factors which the business cannot do anything about. So example of that is the pandemic, especially in this time or these times. It's possible that because of that pressure, certain companies might set aside internal controls to be able to have at least a satisfactory performance and financial position and cash flow. So that's one thing that even as auditors with respect to operational audits must also look into. Then internal control processes have five interrelated components. I would say that we have to take note of these and we have to memorize. I actually have our acronym, so CRIM, CCRIM, in order for us to easily remember these particular components. So we have the control or operating environment. Then this serves as the tone at the top of the organization, how we assess risk assessment, control activities, also known as control procedures. So these are now our specific activities, tasks in the organization for internal control purposes, then the information and how we communicate such and how we monitor overall the other components. So we can say in this particular blue highlighted sentence that all of them should be present to conclude that the internal control is effective. Control environment, as said, is the tone at the top. It sets the tone for the climate of the organization. It is the control consciousness of an organization, and then it is the atmosphere in which people conduct their activities and carry out their control responsibilities accordingly. And then we can say that control environment is effective if ever people are competent. And then we can say that they're competent if they know or understand the responsibilities with respect also to the limits of the authority given to them and about ethics. So they are knowledgeable, mindful, and committed to doing what is right and doing it the right way. So not only the knowledge about what is right, but also in action. So both in theory and practice. The control environment is greatly influenced by the extent to which individuals recognize that they will be held accountable. This is very true. So example, if employees know that if they're going to commit this particular action, then they will be having some consequences with respect to something, let's say warning or suspension and etc. So in that case, the environment with respect to controls would be dictated and influenced by such. Components of control environment. So we have these following items. So we don't have to memorize, but we just have to know them. Integrity and ethical values. So doing the right way about the things that we have known right. So we are committed to such. And in terms also of the competence, then the philosophy, so what we believe in the organization, and when we put them in practice with respect to operating styles. Then the structure, the organizational chart, in terms also of delegation of responsibilities, prior to that will be the authorities and the oversight group. So who are the guardians or the watchdogs in the organization? Then such are discussed, or those a while ago are discussed exhaustively. For the integrity and ethical values, this would be the formal codes of conduct and policies, communicating appropriate ethical and moral behavioral standards, and addressing acceptable operational practices and conflicts of interest. So, in other words, we have the guidelines for us to be guided as to our actions. Then management appropriately addresses intervention. So management will be setting in or will be getting into certain items or overriding internal control, especially for management by exception, wherein the situation requires for the management to explain or take action about certain things. Then commitment to competence. So here we're talking about the management and those people in the organization are qualified with respect to their particular jobs and they understand what they're doing and they're taking actions about such. So we have the formal job descriptions and then for in terms of trainings for the needs of the employees. For philosophy and operating style, we have appropriate attitude toward risk taking. In business, again, risks are there. So what would be the attitude of the organization? Then in terms of assessing the performances of everybody, we have the performance-based management, and there has not been excessive personnel turnover in key functions. So there has been some dramatic changes with the personnel. So that could be one question or area that we can actually look into. Why is it that we are changing our employees a lot of times, such as operations and program management, accounting, or internal audit? So these are some key functions, and we're talking here about the managers. So why are we changing a lot of them, like most of the time? So we can ask ourselves, it's perhaps because of the philosophy and operating style. Structure is with the organizational chart, which also shows the size and the nature of the operations. Then later on, in connection with the authority and responsibility as delegated. So the degree of centralization versus decentralization. What I like about this one is that it shows that there's a balance because in real life there is no such thing as really 100% centralized organization or business and 100% or 100% decentralized. It's really a balance of the two. So we have the centralized part of the operations and counterparted with the decentralized aspects. Then there are clear reporting relationships to whom do certain employees report to and certain key managers or key management personnel will be reporting to and vice versa. Then human resources, policies and practices in terms of recruitment, in terms of training, orientation, compensation, discipline, and termination. Also with promoting or promotion, evaluation, and counseling. Oh, orientation is also highlighted. So all about human resources or personnel items. Oversight groups will be those who will be monitoring and reviewing after the actual operations and programs. So there would be the audit committee, or we also have our own set up internal audit staff and department, for example, who will be doing operational audit. So we have here consisting of high level line and staff executives that review the internal audit work and coordinate closely with the external auditors. So internal audit operation reports the entity's head, then reviews about the activities of the units, systems, provides information, analysis, appraisals, recommendations, and counsel to management. Bottom line, so reviewing what has happened in the organizations in terms of operations and all and programs. Then the second aspect or second interrelated component is risk assessment. In here, the central theme of internal control is to identify risks to the achievement of an organization's objectives. There are the so-called business risks, which would mean the failure or the risks, the chances that the organization would be unable to achieve its business goals and objectives. So there are risks involved to that. To do what is necessary to manage those risks, because we cannot eliminate them overall, we cannot reduce them to zero levels. All we can do is to minimize or lessen or decrease or diminish or manage or mitigate the impact of those risks. Thus, setting goals and objectives is a precondition to internal controls. Meaning to say, goals and objectives are there prior to establishment of internal controls because the internal controls would be addressing the risks involved in achieving or preventing the achievement of goals and objectives. We have here the organizational objectives. So we can group them into, of course, the three areas by which internal controls also would be achieving and would be fulfilling the business objectives. So we have operational. So if we can just make a graph about this one, there will be some sort of alignment with respect to the objectives of the organization and then the purpose or goal and the audit. So organizational objectives of the business, we have, of course, one is operational objectives. We have the operational audit that can actually address to that if ever we have really checked and we have really had the effectiveness and efficiency of operations. So basically they're aligned. Also, we have the effectiveness and efficiency of operations, including performance standards and safeguarding resources against loss. Then financial reporting objectives with respect to the preparation and presentation of financial statements, including our reports, financial matters, so that there would be prevention of fraudulent public financial reporting, especially if or when the financial statements are now issued to the public because they are audited. Also, if there are some laws, regulations, rules, and contracts, so are we compliant? Are we able to adhere to such? Then these are the matters under compliance objectives. Risk assessment is the identification and analysis of risks associated with the achievement of the three organizational objectives. And how do we manage those risks? Then identify the risks after we already established our goals and objectives. A risk is anything that could jeopardize the achievement of an objective. This is a good definition. Jeopardize meaning that could prevent or stop the achievement of an objective. Then we can ask these questions. So what could go wrong? What are the situations in which we could be wrong? Then as well as we fail, then what must go right for us to succeed? Which means that what are the correct items or what are the correct actions, courses of actions that would lead us to success. Then we should know our weaknesses for us to be able to address them. That's why we have the question, where are we vulnerable? Then what assets do we need to protect? Because the assets are devoted towards business objectives. How do we protect them? How do we safeguard them? Are our liquid assets or assets have or with, do they have alternative uses? Because it's possible that they're just kept there, but there could be some opportunities to earn more. And this is quite, of course, important because the question is, how could someone steal from the department? So this is now a matter of prevention of certain people to gain access, especially unauthorized ones, of assets of the organization, and they're going to appropriate such for their personal gains and advantages. And many questions. So disruption of operations. How do we know if we are hitting our objectives or goals? Then what information should we rely upon? Then where do we spend the most money? And what areas? How do we bill and collect our revenue? So items now of setting up the company accounting policies or departments or areas and functions. Then what decisions require the most judgment in addition to where do we spend the most money? What activities are most complex? And we have to subdivide so that those actions will contribute to our overall business function, which will be geared towards overall business objectives. Then what activities are regulated, or meaning to say we have the laws governing to such. Then greatest legal exposure in relation to the previous question, which would be risky or riskier in terms of our laws or legal aspects. Then we should know that our risks have actually cost both quantitatively, meaning to say amounts, peso and dollar values, and qualitatively in terms of other items which cannot be directly stated as financial matters or in money matters. Then quantitative cost, for example, we have here the cash dollar loss or peso loss, then cost of defending a lawsuit in cases that there would be some legal matters. And qualitative cost, I would say, would be very highlighted. We must highlight at this point in time because this talks about the loss of public trust. So example, if there will be some litigation items, even if let's say we are innocent about that, we are actually the aggrieved party, but it can have impact on the reputation and integrity of the business. Then as auditors, we must be checking about such or operational auditors for that matter. Then violation of laws, default on a project, our client is not able to meet deadlines for so many times, that could be our risk indicator, and bad publicity. So because of those some corporate scandals or issues, then the corporation now have bad publicities or bad reputation. And as such, management should be able to analyze, and as auditors, we should be checking if the managers are doing some sort of risk analysis procedures so that they would be able to know how to address and minimize the impact again of those risks. So they can have formal or informal analysis. So it depends upon the company or both. Then criteria could be low, medium, and high. So organizations could be classifying such, then certain appropriate levels are involved in the risk analysis, not only the managers, but also the employees. And of course, the risks should be relevant to our objectives of the company as a whole. Now, how do we manage risk during change? So, example, we must give special attention to risks like these changes, hiring of new personnel to occupy key positions. So, we just have to take note that if ever that personnel is not having the skills, so that's something that could be risky, or if that particular person is not within the business or organization or not being able to acquire the relevant practice and experience, so it would be posing risks, especially if the newly hired will be coming from outside of the business. Another one is introduction of new or change information systems. That's one thing. Then there's rapid growth in the market expansion, and sad to say, the opposite is downsizing of the business. Then production or provision of new outputs or services, which would be risky because the market is not yet knowledgeable about the product. And establishment of operations in a new geographical area. So we are new entrant in the market or markets. All right. This is the part one of discussions of internal control processes. Stay tuned for the next part. Thank you and God bless.